Now, the income statement is probably, depending on the company, could be the most important financial statement in the firm's disposal. And the reason that I say it kind of depends is because for many small businesses, an income statement is kind of a reflection of of the cash position. Now, for larger firms, the statement of cash flows is going to be extremely important because it's going to reflect those cash inflows and outflows. It's going to track where the money is going to. For smaller firms rather, because they use the cash method of accounting, which means they track transactions when cash moves, either being paid or received, and they enter a transaction accordingly. The income statement can oftentimes be a very, very accurate gauge of cash flow and can be a very important financial statement. So let's talk about kind of the income statement and really the purpose of it, and we'll get into the structure of the income statement. For time purposes, I'm not going to go into all of the individual categories. I'm going to give you a general overview of the structure and talk about the types of things that you will see, and then we can finish up this video. So the income statement is designed to summarize financial performance over a period of time. And so period of time is very open-ended. It could be a day, a week, month, a quarter, or a year, or even multiple years. So we're trying to take all of the financial transactions that operate within a period of time or that occur within a period of time, and then we're essentially trying to kind of group them and categorize them together based upon what those transactions are for, whether that's revenue, whether it's certain expenses. And expenses is a very broad category. So is it expenses for marketing expenses? Is it expenses towards salary? Is it going towards materials to produce products? And then, of course, we're going to categorize all those things. And then we're going to determine at the end of the day, is the firm profitable? And that is a very important metric. Profits, revenue is important, but profits is also important because it shows that we're operating efficiently. We're taking money in, and that our expenses aren't to the point to where, we are essentially losing money. So profits are the end result of the income statement. And so we're going to walk through kind of the general structure of the income statement. But just remember that we're looking at a period of time here. So where the balance sheet is giving us a snapshot of what our assets, liabilities, and owner's equity are at a specific moment in time, our income statement is summarizing financial performance over a period of time. Again, whether that be a month, which is very common, a quarter is very common, and then a year is very common as well. So to start off, the first thing we have on our income statement is obviously going to be our revenue, sometimes referred to as sales revenue. Now, revenue is essentially the money that we generate from the firm. So this is what we generate by selling goods and services. Every for-profit business earns some type of revenue or attempts to earn some type of revenue. And they do this by selling various goods and services. And so, to get to this figure, this is really simple if you sell like one product, right? Because you just go ahead and take, the dollar amount or the price per product, and then you just go ahead and multiply that by the number of products sold. But if you are a large corporation that sells a variety of different goods and services, which specifically goods being tangible products and services being intangible products, then this can be very, very complicated. But it's the first figure that we have. So anytime that we sell or offer things for a fee, that money counts as revenue, of course. Now, the next component, and this is broken down kind of more specifically in an actual income statement, we have our expenses. And these are essentially the kind of costs to run the business. And I'm going to break these down in a couple of different categories. The first thing that you'll probably see on an income statement is going to be, cost of goods sold. And cost of goods sold essentially is what we had to pay to earn this revenue. It's sometimes referred to as costs of revenue, costs of services sold, cost of goods manufactured. It depends on the type of business. They usually will change the wording a little bit. Cost of goods sold is probably the most general type of term to refer to, what it costs us to produce the revenue. So let's say that we're a manufacturing firm and we produce some type of a tangible product. Let's say we produce smartphones and we make revenue from, of course, selling said smartphones. So our cost of goods sold are going to represent all of the individual components that went into producing those phones. So it's going to include things like direct labor, which is the actual labor associated with putting together the phone itself that goes into the assembly. It's going to include our direct materials, which are going to be the actual smaller components that actually go into the product itself. So, this is going to be all the supplies and the screens and all of the everything that goes into creating that particular smartphone. And those are our cost of goods sold. For a retailer, it might look a little bit different, right? A retailer, of course, purchases already assembled goods and provides a marketplace, and so sells those to customers. So their cost of goods sold are going to be what they paid to get the goods so that they can essentially sell them to other people. And this is a really important thing here because, of course, we want to make sure that we are charging more than what it costs us to produce the item or what it costs to acquire it. You'll also see other expenses. You'll see things like administrative expenses, which will include your, office workers and managers. And we don't necessarily include those in cost of goods sold because they are a indirect expense, which means they don't directly go into creating the good or the service. But they still are expenses, right? If you have administrative salaries, so managers or secretaries, office managers, they still provide and perform a service for the company, but they're not directly involved in the production or the creation of any types of goods or anything. And then, of course, you'll also see, things like marketing expenses or selling expenses, which can include if you have commissions for sales personnel, can include marketing expenses. So, trying to highlight some of the things that the firm offers and those sorts of things. At the very end, there are going to be more expenses, and we of course have, taxes and interests and things like that. But at the very end, we get to kind of this bottom line figure, which of course is going to be the profitability of the firm, which is a very, very tracked figure. It's very, very important because of the fact that it is a reflection of, not only the money that the firm brings in, so we have to bring in a sufficient amount of revenue, but we also have to operate ourselves efficiently. So, we have to make sure that our expenses are somewhat in line and all the way down the board from our cost of goods sold to our administrative expenses, selling expenses, and all those other types of things. So profitability is that last metric that, after all of the costs have been accounted for, whether it's going directly into the product, whether it's covering, buildings or fixed costs like rent and utilities and all these other different types of things. Are we actually making money at the end of the day? So this was a very simple example because we stuck to some of the broad categories. But when you're looking at an income statement, you're going to see three components. You're going to see revenue, so money the firm brings in. You're going to see expenses, so money that is going outside to cover whether it's goods, whether it's fixed costs like keeping the lights on or lease or rent. And then you're going to see that profit piece there. So at the end of the day, over this period of time, whether it's a month or a quarter or a year, did this firm actually make any money over the course of operating?